Friends, welcome to Financial Market Secrets by me, Dr. Rahul Dandekar. Today we will see currency economics. Okay, currency economics, and the topic is don't fret over the rupee. So अपना जो इंडिया का रूपी है उसके ऊपर don't fret. So what is fret? We will see the currency economy in that sense. So here we can go now. So here Dheeraj Nair says there is much fretting about the depreciation of rupee vis-a-vis dollar. Okay, it is commonplace to equate a strong currency with a strong economy. Strong currency and strong economy. But that is not true, especially in an emergency economy. As long as there isn't too much volatility and there are sufficient foreign exchange reserves, a depreciation of the rupee is nothing to worry about. It is important to understand that the exchange rate is a price fundamentally determined by the forces of demand and supply. In the context of the dollar rupee rate, the depreciation of rupee happens when the demand for dollar is stronger, or as a corollary, the demand for the rupee is weaker. Also, the US dollar is not just any currency, it is the global reserve currency, the primary medium of exchange for most international transactions, and the premier store of the value for the foreign exchange reserves of the most countries. Now, what has happened in the last several weeks is that the US Federal Reserve has raised interest rates sharply in a bid to fight unprecedented inflation, which has led to a flight of capital from countries like India into the US. Such an exit of capital increases the demand for dollars and reduces the demand for rupee as investors sell their rupee dominated assets and take dollars out. Just like for any good and or service, when the demand increases, so does the price. The dollar becomes more expensive vis-a-vis the rupee. The Reserve Bank of India can go against the market movement and sell the dollars it has in its reserve in exchange for rupee to stem the fall in the rupee's price against the dollar. Indeed, it has done so, but in the end, the quantum matters, right? In the end, what matters? Quantum of the money that trades in financial markets drops the reserve the RBI has. So the central bank can only mitigate but not reverse the trend. So trend, what's the trend is going globally is important, guys. From this you can learn trend is important. So you have to follow trend while in financial market. Okay, this is important and this is secret of financial markets. So while you are uh, taking maximum profit, you have to watch for trend. Trend is secret of market. Exchange rates are ultimately market determined by forces of demand and supply. In any case, it is a fallacy to equate a strong or appreciating exchange rate with a strong or prospering economy. Perhaps the only countries that have prospered with a consistently strong or overvalued exchange rate against the major currencies are oil producing economies. Okay, again, oil is important. Hmm? But they have a peculiar economic structure. They export an expensive commodity that has a bright inelastic demand and they need to import practically all other goods. Hence, it makes sense for them to maintain a strong exchange rate that strong exchange rate very strong exchange rate that makes export expensive and cheap, right? Every other country, particularly emerging economies, prospers when the exchange rate is relatively undervalued against major currencies, giving them a competitive advantage for exports of goods and services other than oil. China's entire growth strategy for 3 decades, starting in 2010, depends on an undervalued renminbi. Earlier, Japan too based its export-based growth on a weak currency yuan. Right. So here it is. Just see. So currency market is valuable and it's very important. Hmm? So let again we'll go this last topic. India. India, there has always been an implicit preference for a strong exchange rate. Part of the reason is political optics, but part is also economic. India is hugely dependent on energy imports. It imports almost 90% of its oil requirement, and a weak rupee makes this critical item more expensive in domestic markets. So you can understand 90% oil is imported from outside in India. Okay, since oil or energy is an input to everything else in the economy, oil is everything in economy. Without oil, economy will not move. So oil market is very important. So crude oil finance is very nice market, and you have to trade in crude oil and make maximum profit from it. It affects the general level of inflation and even growth, as also the current account deficit and fiscal deficit because of related subsidies and taxes. In short, when oil prices are high, as they are now, a decline in rupee can be very disruptive. In India, or at least its policymakers, would be much more comfortable about the level of rupee if the country had energy self-reliance. That is a very worthwhile goal. It requires a two pronged approach, increasing the exploration and supply of oil and gas domestically, investing in the scaling up of renewable energy technologies. A weaker rupee would complement the other policies that Indian government has put in place to boost manufacturing in India. It must also noted that currently the rupee is not a global currency because there is no full capital account convertibility. Again, policymakers have been rightly cautious about liberalization, which can also open the door to more volatility. However, eventually, as a very large economy, India will open its capital account fully. Once the rupee is an international currency, debates about its strength become more important. Until then, it is crucial to make the most the exchange rate to gain a competitive advantage. A strong currency rarely lays the foundation for a strong economy, but a strong economy paves the way for a strong currency. The author is Chief Economist Vedanta. Okay, so guys, enjoy. Life is beautiful. We have to enjoy.